Hey, everybody, welcome to the show. So, the entrepreneur or business owner is often asking, how do I build this? The investor asks, how much can this become? And the lender asks, can this survive? So, today we're talking about what business owners can learn by seeing their company through three very different perspectives: the operator, the investor, and the lender. We're going to explore why growth can create as many challenges as opportunities and how understanding the lender's mindset can ultimately make us stronger business owners. Our guest today has had the rare opportunity to sit in not one, not two, but all three seats. As an entrepreneur, investor, and one of the country's leading SBA lenders, Nimi Natan understands that building a successful business takes more than just revenue. He believes it requires strong relationships, disciplined cash flow, and earning the confidence of those willing to invest in, lend to, and support your vision. That perspective has helped him shape and scale Gulf Coast small business lending by focusing not just on transactions, but on the people behind the businesses they actually serve. Mimi, welcome to the show.
Thanks for having me, Crystal.
So, all three seats, that's very exciting. So, you've been an operator, you've been an investor, and you're one of the country's leading SBA lenders. So, how has sitting in all three of those seats changed the way you look at entrepreneurs?
Thank you for having me. Not at the same time. So started out as a operator, owner of a small restaurant, then got into private equity, eventually ended up in structured finance and lending, which is what I do now full time. I think what you learn really as an operator more than an investor affects everything I do. Every time I look at a new loan opportunity, a new business plan, I always think back to starting a restaurant and trying to grow a restaurant, and all the mistakes I made. So many mistakes. All the mistakes I've made, and making sure that as we look at an opportunity, I keep those mistakes in mind. So let's not do that again.
And I imagine you've seen not just with your own mistakes, but quite a few mistakes that businesses that you've helped have made.
We
And that,
do.
yeah, and
It's
that's shaping things.
Yeah, it's hard. Owning a business is hard. So yes.
I think there's many of us listening that could agree with that. It definitely has its ups and downs. You've really helped grow your organization dramatically. And I think one thing that really stood out to me is your emphasis on relationships over transactions and your belief that relationship capital is one of the most overlooked drivers of long-term growth. Where did that belief come from? Where did it start from?
I think you pointed out my background, and it's probably when my dad was in the restaurant business when I was a kid. Didn't speak An immigrant, didn't speak much English. So I was dragged to a lot of the business meetings. And when he had an opportunity to buy a restaurant, I was dragged along with him. And that loan, he ended up getting the loan, an SBA loan actually. And it would not have happened if he didn't have the relationship with, in that case, the bank president, a small bank, three branches, Eastern Shore of Maryland, Frank. And they used to play tennis together. So when my dad decided to leave corporate world and buy a restaurant, Frank knew him, knew his motivation, knew him as a person, made the whole interaction, not just Frank believing in my dad, but my dad feeling comfortable discussing what he wanted to do with Frank because they had that personal relationship, because he beat him in a game earlier that day. I think that drives the point home, the whole point of community banking, working small businesses, working with, in that case, a small bank. I think I carry that experience forward. So when we look, we look at hundreds of potential transactions, but behind every one of those transactions, there is an operator, there's a family, there's a community, there are employees. And in many cases, that's what drives our desire, our ability to either do the loan or not do the loan. It's our belief in the operator, who ends up being a borrower. But first of all, we look at that person as a person. Can she do this? And only then we start diving into the numbers.
So from the can you do this perspective, you've sat on several different sides of the table and you've really felt the pressure, I think, of being an operator. And now as you speak, you're evaluating, businesses as a lender. You told a story that I think speaks to that. Can you do this? Early on, where as a restaurant owner, you ran out of burger buns, and I
On
affectionately
a,
have
on a
referred to it.
Friday night during the summer, on a very busy weekend.
Yeah, I call it the burger bun story. So, but I feel like this taught a powerful lesson about cash flow. So, can you share that experience and tell us how it really
Sure.
the way you think
So
about businesses?
sure. So my mistake, I was 20 years old. I was a chemistry undergrad. I knew nothing about business except watching my dad running a restaurant, at the time, two restaurants. And he wouldn't let me into the business, but he helped me buy a small restaurant in Ocean City, Maryland, which I ran all through college and a couple of years in grad school. And first lesson was not ordering enough burger buns ahead of a very busy weekend. So 6, 7 o'clock on Friday night, we're out of burger buns, which is a problem for a burger joint, which we were. And so send somebody to the supermarket, bought every hamburger bun on the shelf, and we were fine. We made it through the weekend. We didn't make any money. So revenue was great. We sold. We didn't sell out, but we didn't make any money because we had to buy retail. So if on a wholesale level the burger bun is 10 cents, at a retail we probably paid 80 or 90 cents. We simply weren't making money despite the revenue. Lesson learned. Now, fast forward, got into business and went to business school and learned about how to spell EBITDA and what it means and cash flow and free cash flow and all those things, earnings per share, completely irrelevant. I still would have made, if I focused on profitability, I probably still would have made the same mistake, which is not remembering that I need inventory. So this distinction between profitability and free cash flow, in this case, me needing to go into the cash register, grab whatever was there, go to the supermarket and buy burger buns at retail, just made for a terrible weekend, but a good lesson. And I keep thinking about it and I talk about it a lot. And when sometimes the first thing we see when an opportunity comes to us is I guess, the offering memorandum, what the broker used to sell the business. And it talks about a thing called SDE, or profit. And the first thing that comes to my mind is, did they put enough liquidity in there to buy those bonds? Because it's, profitability is great and you can base valuation on it maybe, but whether a business will work or not work has much more to do with how much working capital do they need? How much inventory do they need to start a business or to run the business? And if you haven't done it before, you haven't had a bun story to tell, you may miss that. But we look at it very carefully. We look at the needs, the cash needs of a business and cash generation ability of a business. We put all the weight in that. Our analysis is very much about what is the cash flow of the business, the free cash flow of the business. After you take into consideration buying inventory and accounts receivables and accounts payables and capital expenditures, all those things that may or may not be in the initial analysis that a buyer has or somebody writing a business plan, but we know you need it. So we factor that into every deal we look at. And I can trace that infatuation, obsession with free cash flow to that weekend.
So, as a business owner, how should we really start to think about developing our understanding of working capital and
Yeah,
then and free cash flow as it relates to our and we obviously have a lot of different types of business owners who are, listening to us, but
Mhm.
are there some general guidelines that you can give us that would help us start to shape how we should think about that?
Yeah, so every business is different. So the free cash flow the calculation of free cash flow will be different. The most important thing is to remember that SDE or net income or what some people call cash flow is not the true cash flow of the business. You've got to subtract from it the working capital requirements and the capital expenditure requirements of the business. So if a business, you get a offering memo and it says SDE $300,000, growing at 20% clip, which is wonderful, but they buy their goods somewhere. So figure that cycle. How long does it take? This is an example. How long does it take between the time you make a sale, record a sale, the time you actually collect the money? Now, in the restaurants, less of an issue, right? Because most of it is credit card or cash, so you get it within days. But you're selling to Walmart, you're going to wait 60 days before you get paid. But you have to buy the inventory, you have to manufacture, you have to pay your employees during that period of time. So that's in some cases, a funding gap and there are ways around it, by the way. And we spend time telling operators how to do that. So it's not a killer concern. We just want to make sure that the operator is aware that SDE or profit does not equate to cash generation ability of the company that they're interested in. There is more that goes into the calculation. And again, inventory, accounts payable, accounts receivables, capital expenditures, those are the big things that we often identify that weren't flagged during the initial. They're never flagged during in the offering memorandum that people base their interest on the business as a result. And you're going to say to yourself, I can calculate that. We really like when there are outside professionals involved in a funding. When we see a CPA or a good accountant, doesn't have to be a CPA, we feel better because they've seen thousands of those instances where businesses are profitable on their financial statements and on the tax returns, but once you start running it, they're not generating cash. They can't meet payroll. And it's typically because they forgot that they have to buy $100,000 worth of inventory to operate. So advice one is, excuse me, advice one is be aware that there is such thing called free cash flow, which almost always reduces the profitability of the company. One, two, don't hesitate to hire an accountant to help you sift through all that.
There's quite a few things in there I can think that they would be bringing to the table that demonstrate that they're actually going to be fundable from an investor's perspective. That it seems obvious, like you're in a business where you're buying inventory. How could you forget that you're actually buying inventory? But it sounds like it's something
It's
that
it's
people are missing.
the beauty of entrepreneurship is a lot of us went into it without knowing anything about the business. We're ambitious. We're above average smart. We got away with things in our past. And how hard can it be to run a restaurant? And we love that. We finance people who come from one background and move into something they've never done before all the time. We love that. But you got to know what you don't know. So, so we run into it all the time. It's not being aware of it when they approach us. It's not a big deal. We bring it up, right? That's because we've been through this experience so many times. We know how many payroll periods there are in every month of the year. So we always say, how are you going to make payroll in, is it October or November that has three payroll periods? So you got to
Over.
think about that.
Yeah.
Or when we look at a business like staffing, which is very working capital intensive because your terms with your customer typically 60 days. You make payroll every week. So we've seen enough of it to flag it as soon as it comes in. And at that point, we can work with the borrower and work on the models. Okay, how much capital do you actually need? So you need $1 million to buy the business. How much do you need to run the business? How much more? And what we do is we almost always try to overfund deals, not because we want to give them more money so our payment is bigger, because putting out more money is riskier on paper. But in fact, we know that we don't know everything about the business. We know that the new operator doesn't always know everything about the business. So having a liquidity cushion is good practice, and we always try to either overfund the request or provide a line of credit, a credit card essentially, just in case. So, oh no, I need, I have this extra payroll, or I have this great opportunity to get a new client, but I have to buy $100,000 worth of inventory. How do I do it? So there are tools to deal with that shortfall. Um, it's just something that we work through when opportunities come to us.
So, from the investor's perspective, you said something very interesting when we were first talking. So, if a founder is looking to bring in investor money,
Mhm.
and they've created their investor presentation, you said sometimes a founder will present that same presentation in a lending conversation.
Yeah,
And you said that can be a huge mistake that they can unintentionally make themselves less fundable. Can
yeah,
you explain why that is? Because it would seem like, well, these are all the positive points of my business. This is everything I want to highlight. And in both cases, you're looking for money. So what's really going on there?
yeah. So, well, they scare us. Uh, Entrepreneurs are, they have to be very optimistic and very enthusiastic, or they're not going to be good entrepreneurs. They can't, their risk aversion isn't very high. They're taking a lot of risk, and it's great. It's what makes small businesses happen, right? My dad leaving a corporate job and opening and buying a restaurant. It made no sense, but he wanted to do it, and he did it. So I don't want to take away from the spirit, entrepreneurial spirit. I mean, I started Gulf Coast Small Business Lending with three people. So, we have that drive, and we sometimes ignore the risk. When we pitch to investors, and I'm guilty, when we pitch to investors, it's it's everything is great. There might be a footnote on risks. If it's a big deal, the investment banker will make you put the risks in, but it's a very positive document. We're going to the moon. We're going to be huge. We're going to go public, AI, whatever. And it's great. We love that. The investors, by definition, have similar propensity. They like to invest in exciting businesses. They don't want to see 5% growth. Investors are going to be like, whoa. The problem is when you pencil it in, it doesn't always work perfectly. And a lot of it has to do actually with working capital. So revenue is great, EBITDA is great. The investor is thinking, man, I'm coming in at the ground level. I'm not paying a lot for my investment. They're going to take EBITDA from 0 to $3 million in 5 years. The exit multiple is going to expand from I'm buying it at 3 times, they're going to sell it for 6 times. We make a lot of money. Lenders, first of all, we're more risk averse. So we're not investors. We have no upside. Our upside is the company can service its debt. That's it. We don't take warrants. We don't take stock. We love it when the operator is successful. We don't participate in the spoils of winning. So we go for a different model, right? We just want to get paid. And as a result, we're more risk averse. And our job is to look hard at the assumptions and think about what could possibly go wrong. And I can tell you that a model that shows tremendous growth and margins that are generally not seen in that particular industry, and we know all industries cold, it might excite an investor because an investor say, you know what, they're not going to hit their numbers, but if they only hit 50%, we'll be good. A lender looks at it as it's going to blow up. They're going to overspend to get revenue, and they're not going to hit their numbers. Where are they going to buy those burgers? They're not going to have money in the cash register to run to the supermarket and buy those bonds. And if they do find those bonds, they're not going to cash flow that we can. How are they going to make payment on our loan? So the model that is exciting to the operator, and they believe in it, is very exciting to an investor, might scare us greatly. So my advice is not to have two completely different presentations. My advice is to temper the enthusiasm and make sure that we don't care about exit multiples and things like that. It means nothing to us. What matters to us is the cash. I'm going to say it again and again. What's important to us is the cash generation of the business and its ability to service debt. We don't need tremendous growth. And from experience, when you run the models, tremendous growth for a 10% business, or worse, 5% business, let's say you're a distributor, you're only making 5-6%. Growth, when you pencil in tremendous growth, you will run out of cash because you won't be able to buy inventory. We haven't seen a lot of businesses, especially startups, and we finance tons of startups that can self-fund tremendous growth. So don't scare us. Give us a more tempered projection, even if you shoot for the moon, and make sure that part of the projection takes into consideration working capital expenditures. I'm going to take a loan maintenance company. I'm going to buy it. It's maybe $1 million in revenue. I'm going to grow it to 5 million very quickly because I'm going to get some great commercial accounts. I'm going to get the municipality in, whatever. You need equipment for that. How are you going to buy that equipment? So what we hope people do is, one, temper the enthusiasm a little bit so they don't scare us. Two, calculate your cash flow. So see what else do you need to be able to grow. Equipment, more inventory, your accounts receivables will grow. What kind of cash do you need? What kind of cushion do you need to be able to support that growth? Now, that can come from equity investment, or it can come from debt investment. It can come from the initial injection of cash. It can come from the operator's own liquidity on their balance sheet. They might have an IRA that they can tap into, or home equity, or maybe they got a great package when they left the corporation. So I don't want to come across as if we're not interested in high growth. We're not interested in investor-led. opportunities. We just approach it differently, and we hope that the borrower comes to us knowing that we're looking for something a little different.
It sounds to me like what you're really looking for is a balance. So
Yeah,
you need the enthusiasm, and
we do.
the business owner needs that belief in success, but I like the word that you used, tempered. It needs to
Yes.
be tempered with the understanding of success is predicated on factors, foundation, things that are happening in the background that are going to allow it to grow at a rate that's actually healthy. So can you give us an example, maybe one of something you've seen in the news on a company where you saw them growing so quickly they started to have financial problems? And would it be one that you can think of in the last few years that we'd recognize?
Well, I'm not going to pick on any of my competitors who blew himself up by growing too fast. Um, I think one that is was in the news, and maybe the viewership heard about, is the used car dealership, Tricolor. That was huge here in Dallas. It was a subprime. Um, when used car were very expensive, they got into the market and really had great deals. We bought a car from them and made cars accessible to when things were really, really crazy expensive after COVID. They grew very, very rapidly, ran out of cash. I think there's probably some fraud involved as well, which contributed to it. They were fed by what's known today as private credit, so unregulated lenders, and who just kept feeding them cash to grow, but the business didn't generate cash. And in the car dealership industry, financing is a huge deal, right? You rarely would go into a car dealer and plop down $20,000 for a 10-year-old Camry. So what happens is when the consumer is hurting, as the consumer was hurting during that period of time, they defaults on their car loans grew. Repossessing is not a good thing for anybody. So they ended up blowing themselves up. And they pretty much brought down the entire private credit industry with them. So their ramification, this was a big one, the ramification for for um, for the economy as a result of that. Less capital, there's less capital available because of how a company of that magnitude managed their finances.
So, after evaluating so many businesses, are there qualities that you see or observe in a business owner that immediately you think, I'm confident in this person, versus I'm not so confident in this person? You know, what should we be thinking about in terms of that as business owners? Numbers aside.
The answer is yes, but I can't tell you why because I don't know. I can tell you that we assess businesses far better when we meet or speak with the borrower. Today's world, for a large lender like us, we don't always get to spend a lot of time with the borrower. And in some cases, there is an intermediary, a broker, a lawyer, somebody who is doing most of the talking too. So we don't always get a great view, and we judge the person, and we make mistakes too. We sometimes think somebody is great and they turn out not to be great. So it's hard to predict who is going to make a great business owner. It's part of the again, it's part of the allure of the business is none of it is a sure bet. You definitely are gambling on the people you back. Now there's some telltales. People deride credit scores, but personal credit score happen to be good predictors of how a person would behave as a business owner. So we do look at that. So FICO is important. And we typically ask for it fairly early on. Now, if somebody has 720, there's no information in 720. They can be good, they can be bad. Somebody is at 620, we're pretty sure that that loan is not going to work out. Somebody is at 800, we're pretty sure that will work out okay. Because it talks about not necessarily the ability of a business or a person to pay their bills, but rather their desire to pay the bill. So we can go through a lot of numbers, a lot of spreadsheets, look at projections, look at historicals. It tells us whether a business generates enough cash flow to support the loan. It doesn't tell us what a new owner, for example, would do with all that cash. FICO score, one of the credit scores, and the detail that go behind it actually will tell us quite a bit uh, about that particular loan. They've
So
paid
if
their bills. If they paid their bills in the past, and our analysis shows that the business generates enough cash flow to cover the loan, we'll be okay. If they
so
haven't paid their bills in the past, even if the business shows that it can service the loan, we just don't know. So I would, to the extent that the borrower can clean that up before they show up to a lender.
I'm thinking as you're talking about, what so many people going through COVID may have experienced, and that I think there was a lot of financial hardship. And I think there were a lot of people out there that just because it was such a dramatic shift,
Yes,
and certain industries disappeared almost overnight,
yes,
that there's going to be quite a few borrowers out there who maybe had fantastic credit scores and then something happened, the bottom falls out underneath of them, and they're in the 700s and had to let things go, and now they're in the 600s, but their entire financial history before that was a positive one. But now here they are wanting to get serial entrepreneur, wanting to get back going with business, wanting to get another business off the ground, and coming in with maybe a score that is lower like that. Now I think what we're getting into is the story. So can
yeah.
you take just one quick second and tell us how we can help tell our story as a
Tell the
business?
story. Just tell us what happened. We see it all the time, not just COVID. I think COVID is mostly behind us when it comes to credit scores, medical. So all the time we see credit scores being affected to the detriment by illness that insurance didn't cover. Oh, we take that into consideration every single time. The beauty of people hate credit scores. I get it. People hate credit reports. I get that. But they actually tell the story. You can point, look, the reason why it's low, it's during this period. I was late payment. I was late on my mortgage, which will just kill your credit score. Here's why. Supporting an ill parent or child, whatever it is. Just tell us what happened. And we always take that under consideration. Student debt. We often see a balance sheet, a dentist, 4 or 5 years out of dental school, and she wants to buy the practice from a retiring dentist where she works. She's got $500,000 of debt. No problem. We'll do that loan any day. So it goes back to a question you asked earlier about relationship and getting beyond the numbers, whether it's projections or historical financials or personal credit. Tell us the story. What happened? We really need to understand that it's too We're not conservative. We are in the business to make loans. We're supported by the US government to make loans. That's the essence of SBA lending. We really want to support entrepreneurs. We really want to put money to work. That's our job. So help us with that. Provide all the information you have. Tell us what happened, and let's see if we can work through that.
So, Nimi, I want to close our interview today by asking you a question. If you really about what you want to leave us all with. So, if you could teach every business owner who's listening about becoming the kind of business owner that lenders, investors, employees, and customers all want to bet on, what would be that number one lesson that you would give?
Yeah, I would say, and I hope, so I'm a small business owner. Well, not an owner, I sold the business, but I'm a small business operator myself, right? I run a small company. And we're big in SBA lending, but we're a small company. And what I try to tell everybody here is the empathy aspect of what we do. It's the thing that thankfully AI will never take away from us. It's listen, ask hard questions, get to the bottom of it. But we're, you know, lawyers will describe us and the borrower as counterparties because, we sign documents and I'm on one side and the borrower is on the other side. In fact, we really are on the same side. When things go well, they go well for both of us, for the business owner more than us, but that's okay. They take more risk. That's the name of the game. When things go bad, they go bad for both of us. So, approach every borrower, even if it's an online application, approach every borrower as a person first. Really listen to the story. It doesn't mean you overlook certain things. You have to look at certain things, but I would say empathy, and that goes our relationship to everybody we work with, and hopefully every business owner, how they treat their employees, their partners, their investors, their lenders. Nothing will kill. We have this. We have a borrower who is yelling at one of our loan processors. That deal is dead. It's like you want to kill a deal quickly, just yell at us. So just be a good person, and we strive to do that. So that would be my advice. And I know it's not calculus or numbers and some trick finance. It's really not. This is a people business, and we're part of a community bank. This means so much to us. So I urge everybody to be the same.
Nimi, tell us, how can we follow you on LinkedIn, connect to you on social, and find you on the internet?
Yeah, LinkedIn is great. And there's, I think, only one Nimi Natan on LinkedIn. So and I look like this, except I have a cowboy hat. So if you go on LinkedIn and you Google me, you're probably going to end up with me, and I'll respond very, very quickly. So I check my LinkedIn, and somebody else checks my LinkedIn regularly, and that's probably the best way to do it. Or email works as well. First name, last name @gulfbank.com.
Thank you, Nimi. Okay,
Thank you,
everybody.
Krista.
So as business owners, we really need to be, paying close attention to our FICO. We need to be thinking about the foundation of our business. We need to be thinking about working capital and free cash flow. We need to be thinking through all of these three lenses that we just talked about here today. Thank you for joining us, everybody, and until next time.